Listen carefully, because what's happening right now in the precious metals market is not random, and it's not noise. Gold and silver are under pressure, the dollar is rising, and most people watching price alone are completely missing the real story. If you're looking at charts and wondering why metals are slipping when inflation, debt, and global risk haven't disappeared, stay with me. In the next few minutes, you're going to understand what's actually driving this move, who's in control, and why this phase matters far more than most traders realize. This is one of those moments where smart money is calm, retail is confused, and the real signal is hidden beneath the surface. Before we go deeper, if you want clear, no-hype market intelligence like this on gold, silver, the dollar, bonds, and oil, make sure you subscribe now. This channel focuses on real flows, real positioning, and real drivers, not headlines, not opinions. Subscribe now so you don't miss what's coming next, because the next phase of this market will move fast, and preparation always beats reaction. Now, let's break this down calmly and clearly. Precious metals are under pressure right now primarily because the US dollar is asserting strength. This isn't emotional and it's not ideological, it's mechanical. When the dollar strengthens, especially over short time frames, it tightens financial conditions globally. Gold and silver, being priced in dollars, face immediate pressure as capital flows favor cash and yield over non-yielding assets. This doesn't mean gold is broken. It means the current flow regime is dollar positive, metal negative, for now. What's important is how this pressure is forming. We're seeing session-specific selling during periods of dollar strength, particularly when yields hold firm or push higher. This tells us the selling is flow-driven, not panic-driven. Volume is present, but it's controlled. There's no sign of disorderly liquidation. That's a key distinction. When metals truly break, you see expanding volume with collapsing bids. That's not what's happening here. Instead, we're seeing metals step lower in response to dollar bids, then stabilize. That's pressure, not collapse. Silver, as usual, is feeling it more than gold. Silver is more sensitive to dollar moves because it sits at the intersection of precious metal and industrial metal behavior. When the dollar rises, silver feels both sides of the squeeze, monetary tightening expectations and growth uncertainty. Gold, on the other hand, is behaving more defensively. It's absorbing pressure rather than accelerating downward. That relative behavior matters, and it's something professionals watch closely. Now, let's talk about why the dollar is strong, because this is where many people oversimplify. This isn't about optimism. It's not about economic celebration. Dollar strength right now is about capital preference. In periods where uncertainty exists, but hasn't yet turned into stress, capital often parks in the dollar. It's liquid, it yields, and it offers optionality. The combination pulls flows away from metals temporarily. This is especially true when bond yields remain elevated enough to compete with gold. What you don't see right now is aggressive physical selling. There's no evidence of panic in physical demand, and there's no clear signal of long-term holders exiting. That's critical. Most of the pressure is happening in paper markets. Futures positioning, short-term hedging, tactical trades responding to currency moves. This is not a wholesale rejection of precious metals as an asset class. It's a positioning adjustment. This is where many retail traders get trapped. They see red candles and assume something is fundamentally wrong. They assume the narrative has changed. Smart money doesn't think like that. Smart money asks a simpler question. Has the flow regime changed? Or is this a temporary dollar-driven phase? Right now, the evidence points to the second. Dollar strength is the driver. When that driver weakens or stalls, metals regain breathing room quickly. Another critical point most people miss is timing. Dollar strength phases often compress volatility in metals before expanding it later. This creates frustration. Price goes nowhere or grinds lower slowly, shaking out impatient longs while not rewarding shorts enough to create confidence. That's exactly the kind of environment where emotional traders lose money and disciplined capital waits. And waiting is exactly what larger players are doing. There's no rush, no chase, no panic. That tells you everything you need to know about the underlying structure. If this were the start of a real breakdown in precious metals, behavior would look very different. You'd see disorder, not pressure. You'd see urgency, not patience. So right now, precious metals are under pressure because the dollar is dominating the flow landscape. Not because gold has failed, not because silver is irrelevant, but because capital is temporarily choosing liquidity and yield over protection. That choice can change quickly, and when it does, the move back into metals is rarely slow. This phase is uncomfortable, but it's not abnormal. It's part of the cycle. And understanding that difference, pressure versus failure, is what separates professionals from the crowd. This is just the foundation. In the next part, we'll go deeper into who exactly benefits from this dollar-driven pressure, who gets trapped emotionally and financially, and what subtle signals to watch that tell you when this phase is ending.